Thank you, Hans. It's a great honor to be here almost for the 20th time. It's the first time I speak about Bitcoin. I'm still a little ashamed about it. The paradoxical thing is, of course, it's also the first time I speak about Bitcoin at an Austrian economics conference, but I speak at about a dozen Bitcoin conferences every year about Austrian economics. And it may tell you something already, the tables have turned in a way. So a while ago, you would have assumed that Bitcoin as part of crypto money is maybe a niche interest within Austrian economics. So, because we Austrian economists, we're open. Of course, we're very open for private forms of money. But now it seems like Austrian economics is this niche interest within Bitcoin. And most of the contemporary interest for Austrian economics, most of the young people that are eager to learn about Austrian economics actually are Bitcoiners and come to Austrian economics for Bitcoin. So something profound must have happened. Now, I was the first Austrian economist to try to figure out Bitcoin and to teach about it at university, to write in a book about it. But I've been always very reluctant in recommending Bitcoin because, as you all know from Doug French, economists recommending investment options is one of the biggest scams there is, so I'm not going to pump my backs. I'll tell you rather how my knowledge of Austrian economics has helped me explain for many years why Bitcoin would probably fail, and when it did not fail, what I as an Austrian economist may have learned from that. So let's take that bit different approach to it. So I discovered it a bit too early. I considered myself a cypherpunk. I was an early adopter of e-gold. I was very interested in digital forms of money. I organized a conference on cryptographic money in Vienna. And then in the end of 2009, I discovered in a forum called antistate.com someone shilling this idea of Bitcoin. And I looked at it, and two things became apparent at the same time. It looked like a digital ledger-based form of money, and it seemed something libertarian, something that libertarians would adopt. And both things made me look at it in a very skeptical way. And of course, Austrian economics should make you careful when you look at it. Being a ledger, of course, is a sign of it rather being what in English you call a fiat money. Now, fortunately, in the original German, the word that Mises uses is Zeichengeld. It's token money. So that helped me a bit. It's not that low, but still, it's a form of money that Mises had very reasonable doubts about it, because the problem with any kind of token money is it more or less necessitates the trust that money should actually absolve you from. And then, of course, looking at it as this libertarian token, it seemed obvious. Okay, it's like the 5% of libertarians that take an interest in digital money will maybe care for it, but libertarians are themselves like the 5% of the people who care about liberty, and people caring about liberty are maybe 5% of population, like to be optimistic, and maybe for the US, in Europe probably it's an even lower number. So it seemed obvious, like, okay, there's not enough network effect. If that's really just the magic libertarian internet money, it's nice, I have no issue with it, but certainly economically it will not be that interesting. That's seemed for sure. Now, being a digital ledger, of course, has this big trust issue, but I had learned before from the e-gold story that that's, of course, the main point and the main issue, and that was interesting with Bitcoin, and from the beginning it was all about solving the trust issue. We Austrian economists, we know that money is that important because it allows collaboration between people who don't already trust each other. So that, I think, is a crucial insight from Austrian economics. That's why we talk about catalectics or the catalaxy as the extended order of people cooperating. So that certainly was a point here that seemed interesting. But I had experienced that suddenly all my e-gold that I had stacked was with the CIA, and I had to really clarify with the CIA where that money was coming from and if I were maybe asked to get it back again. So I knew, okay, there's a challenge, but still I thought cryptography is all about concealing things, and there Bitcoin did not really offer a way forward. It seemed like the antithesis to it. It was not about concealing all the cypherpunk. Most cypherpunks assumed it's about concealing transactions. Now Bitcoin does the opposite thing. It's an open ledger of transactions, and that, of course, is something that's hard to get. I think one thing that was misleading, and interestingly, it's Hayek, who I think last year I had fun roasting Hayek on where he was wrong. There are many things, but there are like two things where he's a crucial thinker on understanding Bitcoin. The one thing is he realized, well, changing money is that important. It's such an important protocol. It's a question of power, and the powered interests, of course, would control it. So he had this thought experiment and said, well, I'll need a sly and roundabout way. So something no one would really realize that it may be that important. And probably Bitcoin was hiding in plain sight because it did something. Satoshi called it more or less money, and most people assumed like, okay, it's presented to be a novel form of money. And every economist, not only every economist, I think every reasonable person, by looking at Bitcoin at that time, but still today, would conclude, well, it's no money. They call it a money, it's no money, so obviously it's not working. It's a failure. And still, up to these days, it's the common issue. Satoshi writes about the peer-to-peer cash, and then many people will say, well, it's hardly used as peer-to-peer cash. So obviously, it seems like it's failed, it's a wrong approach, and maybe the sly and roundabout way was exactly like that, hiding it in plain sight, calling it money, so everyone would can say, okay, it's not money, it's not that interesting. And another important insight was that Hayek clarified that money is actually not a thing. And it's just like reading manga carefully and understanding it's about an attribute. And once you understand that money-ness is actually an attribute, of course, you have a more differentiated approach. It's not about like, I look in a textbook and I can tell you if it's money or not. It's a differentiated process. It's a discovery process with manga. You learn about a higher marketability or saleability, Absatzfähigkeit in German, of a good. And you realize that goods have this different nature. It's not the physical nature defining it, it's their attributes. It's the different usefulness. And if you go from there, I could see a kind of discovery process happening. Now, the first time I really understood that Bitcoin may have a non-zero value. And as an economist, my assessment was, okay, now I know it's between $1 and $10 worth. So probably the reasonable thing is to buy 100 Bitcoin for $100 and sell them at 900 and congratulate yourself how useful economics is. You made a quick 800 and it's fine. And I think that was a very reasonable approach at the time. So at least I knew something. It has non-zero value because I discovered Silk Road, of course, purely for scientific interest and reasons. There I discovered that actually the saleability of the digital good is higher for a certain context of people. So for a certain kind of deals that you're looking for, it increases your chances of finding an exchange partner. And that's what it's mainly about, this kind of saleability. You want to find exchange partners. And now, with Silk Road, we had something empirical to analyze. I could compare the street prices of those kind of goods. I forgot which ones. On the street in Vienna, what the price was, and what the price was if I ordered them on Silk Road. And I realized, okay, there's a differential. It means probably more exchange partners, better exchange relations, so it's rational to demand some Bitcoin. Of course, not hold on to it, that would be foolish and stupid, but demand some Bitcoin for it. And it helped me appreciate a kind of discovery procedure that probably the approach to money is seeing a kind of textbook definition. It's either universally accepted medium of exchange or it's not. Probably is not the core principle of what Menger realized. He realized it's like language. It's not a clear-cut thing. It's a discovery process, and maybe different groups, different areas for different needs will have a kind of different discovery history to tell how it's useful. And the core principle behind this marketability is really one of the main issues with exchange is, of course, finding exchange partners, but also that we have the declining marginal utility of stuff. So we offer something to the market, and then those exchange partners that we found are already happy with what we've got. It's really hard to scale. So you want to find additional exchange partners, and that's the reason why, as all of us, almost all of us like meat, not all of us like to have a cow as a pet, but still, historically, it's cattle that's used as money, and in many languages, you still have the reference. So even though people like meat, and there's much higher utility for meat, and it's really cumbersome and very high transaction costs to go from a cow to meat, actually, a cow is much more marketable. And the main reason, of course, is transportability. It moves on its own. It can move from the one village where you're selling meat and the marginal utility goes down because everyone had his stake, and then maybe 10% take either second stake, and then maybe one guy in the room or two guys in the room would eat a third stake, maybe a bit higher proportion here. Usually I'm the only crazy one who would go after that. And it's really great that you can move on to other marketplaces. So this portability seems to be a crucial element. And there's a second element, of course, Menger understood all that. That's durability. It's the kind of find better trade options in the future. And of course, the cow has the same thing, much more durable than meat. So it's not clear, is it really portability? And you need the portability because it has durability and so on. It's both things. And it's really hard to distinguish. And you see, if you read Menger, he has a hard time. What's more important, the medium of exchange or the store of value thing? It's really, if you look at it that way, it's about more market opportunities geographically in a broader space and temporally at a future date. So it's similar things. It's like you try to avoid this declining marginal utility, and some goods have these attributes to a higher extent. And then, of course, is all the story behind the precious metals. Now, interestingly, the mainstream perception, of course, is very different, and they tell us about the big bullion famine in Europe. Interestingly, not too long before the Renaissance, it seemed like Europe was really dark, and the reason a lot of economic historians actually give it is like there was not enough money because there were not economists who like told politicians that they need to produce money because people are so stupid to hold it and to consume and not or not spend it or not consume, those kind of explanations. And the interesting thing is that, of course, it was the time of the Black Death. And as Rothbard has given a very good explanation, it was a time of increased plundering that probably led to a weakening of the immune system of the population that probably led to the Black Death. So it was a time when it was probably not a good idea to have your money in the open. And I think one underrated aspect of the portability, durability aspect, and it really helped me understand a few years later why there may be a bit higher price point than $10 for Bitcoin was when I talked to Chinese entrepreneurs. I went to China, and they told me how to use Bitcoin to avoid capital controls. And then immediately, of course, without value judgment, as a good Austrian economist, I know, okay, there's a demand, there's a clear use case. That's a higher saleability for a certain context of people. So probably it'll be worth $100 one day. So of course the rational thing is like buy 100 Bitcoin for $1,000 and sell them for 10 times or 9 times as much, and congratulate yourself that economics again has proven to be useful. Now what is it about capital controls? I think that's the underrated thing, the kind of portability and durability, and we see that a lot in history. Usually, the most crucial one is withdrawability. Are you able to withdraw your money as a kind of storage of what it worked for and your energy from bad uses, bad structures, from plundering? And of course, the main reason for the great bullion famine was not that money was too scarce. No. Of course, money goes, if it's able to, for its attribute, it will go into hiding. And it was not that people did not consume anymore. No, they consumed a lot, but they consumed things from productive regions in the East that exported all the great goods. and of course you had to pay the money there if you're not producing on your own, because it's a time of plundering, it's time of political consumption. Then of course either you withdraw for a better time or you put your money in a better place. And I think it's hugely underrated how important that mobility of the precious metals was for Europe and for civilization, of course, because without these liquid stores of value that could be transported across borders, I think with the downfall of the Roman Empire, civilization would have been over with. So it was these mobile stores of a tiny minority moving then to Venice and Genoa and the northern Italian cities. And when the northern Italian cities were encroached by the centralized emerging nation states, of course, it moved further north to the Hanseatic League cities, then to Flanders, to the Netherlands. It moved on to the UK, and it's this kind of mobile people, and you see all the same people. You see this, it's Italian suddenly appearing in the Hanseatic League towns, in the Baltic towns. And you see it's like Dutch people appearing in London, and Germans, and so on. And of course, you can only appear as a merchant, stuffing out ships, if you have the wealth to invest in. And combine that, of course, with the innovations and bookkeeping and the corporate structures we had in Europe, you see where all that wealth comes from and how crucial this withdrawability was. So while, of course, most economists claim that hoarding is destroying the economy, we as Austrian economists, of course, no. No, hoarding is the stepping stone for any productive activity, because you can only invest what you have not malinvested before or consumed before, and it has an even higher importance. I think Mises figured that out. He saw the problem with socialism is not that the socialists are inefficient. Of course, they want to be the intelligent technocrats knowing everything better. The issue with socialism is, of course, the distortion of the productive structure, because you cannot say no. That's a crucial thing. That's why he figured out private property is the essence. It's not about the efficiency and the knowledge economy and things like that. Private property is the essence of saying no. Of saying, no, it's mine. I'm not using that for that shit productive idea you have, that kind of utopia you want to do. Of course, it would be great if on my land there'd be these industrial facilities with so much productivity, but I'm not buying it. I'm saying no. And with a liquid form of capital, you can withdraw, of course, and you can say no. And it's crucial, and I think it has become crucial again. It was first understood in China by a mobile population. It's now understood in Europe. Lots of people are either leaving or about to leave and are thinking about how to withdraw wealth. And it's really hard to move your house from Germany to elsewhere. You will need a more liquid form of wealth, and I think that explains, of course, the increasing levels of adoption, this kind of portability and durability. You only understand it when you see the need and the use case, and then you look at the alternatives, and then it's a discovery process of an increased salability. But of course, still, I was pretty skeptical. I know, yeah, for a while you can avoid the state. At least I knew from Austrian economics that it may not fail, because we know since Böhm von Barwerk, he has this contraposition of power versus economic law, and we know it's not always power that wins. There are some realities in the world, and praxeology is our approach to uncover those realities. So we have a little message of hope in the Austrian school tradition that power can't do everything. But still, of course, you don't want to fight a big power. And every reasonable person would have considered in the 90s, as myself, something like Bitcoin to be impossible from the start, because it's a civilian use of cryptography. And the biggest bully on the scene has made it clear that there is no civilian use of cryptography. It's a military technology, so you're not free to use it. And the biggest power on the planet will do everything to go after you if you try to use that. And the biggest bully, of course, was the US. And it was made clear there's no chance to use cryptography for private uses without the permit of the big brother. The biggest power on the planet could not maintain that kind of control, because the reality behind it was that software is just information. and information is hard to control. We know that from history. You can try to censor for a while, you can try to cancel people, but of course it doesn't go away. Sometimes you even draw attention to it, and people figure out information is something we can pass on peer-to-peer. It's really just letters. You could have software, and you could have the core version, the early core version of Bitcoin would have fit into a book. And then you need to have Big Brother looking at every border through every book and try to understand what kind of ciphering you have used to conceal it. So it was practically not feasible. And it would have, of course, made obvious that the biggest bully needs to be a censor and needs to execute. And sometimes that's the way you fight the biggest bullies, just make it transparent what they are about to do. This episode is called The Great Crypto Wars, and they were won unusually by the side of liberty. And so now it has become possible. Still, of course, governments all around the world try to encroach on peer-to-peer information. We're still fighting the war, it's not over, but generally something has become possible that was deemed impossible. So we still always have to approach, I think, with some kind of humility, real history, and I thought that's a great insight from Mises. We don't take our lessons from history because we can deduce it, but we need to look at reality, and we need to apply praxeology as a theoretical help to understand reality, what's really happening, the real history. And I think this approach to Bitcoin is a bit more helpful. So of course I thought, it'll be a stress test once China realizes, and they had like played with it for a while and see, okay, it's a way we can observe how people are doing capital flight, and we'll cut it short. And then China actually went against the big Bitcoin miners, and it seemed like, I don't know, the majority of the hash rate was concentrated in China of all the miners, so it looked like, yeah, maybe that's again the end of the story. Interestingly, we saw how flexible this infrastructure is. You just put the mining rigs into containers, you ship them to Kazakhstan, you sit it out in a way, reinstall these things, and again, it was a very high probability of failure that again, Bitcoin has survived. The hash rate is up again. It is much higher than it was when China shut it down. The price, of course, is much higher. Then, of course, every reasonable person would say, yeah, okay, maybe the infrastructure is distributed enough, it has this network effect, but what about shutting down the interfaces between the fiat system, the banks, and Bitcoin? And the US actually tried to do that. We had a huge type of unbanking of companies dealing in Bitcoin, and a lot of this financial infrastructure moved to other places. And interestingly, just for economic incentives, I think, it has turned around. So we are now in the phase of the current US government being relatively friendly towards it. Of course, there can be some calculations behind it that change later on, but still it's another stepping stone in the story, realizing that the incentives may be even there for actors like Wall Street or for actors like nation states adopting it. So, of course, someone who has contributed more than anyone in introducing Bitcoiners to Austrian economics is here with us. This is Saifuddin. When he wrote his book in 2018, it's quite a while ago, I thought it was ludicrous to write about a Bitcoin standard. Because he had really this narrative where it would replace or be something like a gold standard in the past. It would be really something adopted as a standard currency, which seemed so far off at the time. It's not that it has come true in meanwhile, but now I'd say you can't consider it ludicrous anymore because we've never been closer to that. And why have we never been closer to that? Now, the gold standard, of course, emerged not from a top-down appreciation of governments for gold. It emerged from the use case of a tiny minority of large merchants. And then the understanding of political unities that maybe it's in their interest to go for the value storage that you can move around without permission of other powers. So it has become, and still is, gold is the relatively neutral kind of money. Now, as a Bitcoiner, I'm partly disappointed, but also partly quite happy about that Bitcoin has not been used that much to evade sanctions for Russians and so on, because I was a little bit afraid it would be too early to confront the biggest bully there is on that kind of use case. So gold, again, is shining a bit more, but it doesn't seem ludicrous anymore that with the change of the geopolitical order, we see the need for neutral forms of money go up. We see the need for something that's not a controllable payment system, that can't be easily sanctioned, that you can use without the permit of one of the geopolitical blocks, just as a kind of settlement layer, maybe between big structures, between big merchant or banking houses, and so on. So it doesn't seem ludicrous anymore. I'm not saying we're there yet. I'm not saying that it's the most probable way, or that anyone can be certain that it'll be the outcome. But of course, it's a kind of discovery process in going again from something that you may have considered ludicrous and with no empirical evidence for it to something that has become a lot more probable and a lot more likely. And then, of course, everyone is in the challenging situation. We need to be speculators. Are you going to keep your money in treasuries because stocks are too expensive? What a lot of people do. Of course, there's this big challenge of people needing liquid stores of value because we need to hoard. That's very natural. We don't know what the future brings. To the uncertainty, we need to hold liquid stores of value. Now the conservative solution is holding treasuries. We see already the picture of more and more people realizing not what maybe libertarians had realized before. There's a moral dilemma in holding that. But it's actually an economic dilemma of trust, and this kind of considered liquid reserve is losing its standing. So already this standard recommendation of the 60-40 ratio is bullshit, obviously, doesn't work anymore. So people, of course, will look for different sources of value in different ways in their portfolio. And that's, I think, the most recent adoption, which again was hard to understand, hard to predict, that the bigs of BlackRock and so on Wall Street would try to front-run retail in the next cycle in buying Bitcoin. And having their financial vehicles and buying Bitcoin. Again, it's a trade-off. It's with anything, it's hard to say, is it good, is it bad? It's like it's happening. You're not going to stand on the side. And if you look from the purely value-neutral perspective of the wealth allocator, of course, you need to look at performance, and you need to look at performance corrected for volatility. So you calculate Sharpe ratios or Sortino ratios, and you compare. And then with the maybe 15 years track record, and you calculate these ratios, you figure out, wow, probably a 10% allocation of that stuff actually enhances the performance. You don't need to understand it. You don't need to like it. And that's, I think, what has happened in Wall Street, a very neutral approach of people who like to make money, who know they're early with fiat, the new recipients of fiat. They are looking for assets that retail isn't all in. So, of course, afterwards, it made a lot of economic sense that they would go for it. From the experience, I'd say again, well, Bitcoin will survive that probably, because it has survived a lot of these adoptions that always had a risk. The riskiest adoption probably is the Bitcoin Treasury Company thing now, where companies realized, well, I can sell stocks and try to produce something, but in a distorted world that's a really risky and difficult strategy, and my returns are hard to match. So there are few tech companies that bring all the returns of stocks. The most conservative asset today is a stock index. So that's like, if you don't want to buy treasuries, you go and buy an index ETF as the thing with the next best Sharpe ratio of the Bitcoin. And then, of course, those companies realize, well, I could just buy Bitcoin with the stocks I sell, and We all know it's a kind of casino of dumping new stocks on retail investors that really need them. So there's a slight risk to have this cyclicality again. But Mises was probably right in pointing out that the regression theorem is a misunderstood way, but what he wanted to explain is that discovery process always needs to compare it to something that you've experienced in the past. So there's always a history of adoption of something. So you look in the past and you compare with prices that made it really difficult to figure out Bitcoin from the beginning. Like it had no backing, it was a digital ledger that had nothing behind it, and still that's, I think, a big challenge for most people to see. But as we've seen with stocks that don't really have a relation to underlying value anymore, and we've seen with the discovery after Bitcoin of tokens, like you can sell anything to anyone, and then subjectivity or subjectivism from the Austrian school tells us, well, it's really hard to make a judgment here on people for buying the wrong thing. And of course, there can be a demand for digital things. We all knew from the Austrian school, a good doesn't have to be physical. It can be a digital thing, and you can have a demand for something as if it was a collectible. You know, there are lots of stuff where no one sees value in it, and if they're physical or digital, doesn't make a big difference. So that helped me explain a bit how someone that seemed to me very foolish in the beginning by demanding some Bitcoin that didn't have obvious reasons would just be an initial demand that fulfilled the criterion of the regression theorem, because then you have a price history starting. Someone was offering something for these digital tokens, and we don't need to understand their reasoning and their preference structure, but it doesn't seem like entirely out of the human mind to attach some value to something that's provably scarce, that has a fun history behind it, that has a fun technology behind it, that has fun people around it adopting it. And then once you have that history, of course, that helps a lot with every cycle. And we see with every Bitcoin cycle, we remember the price it had in the past, and it changes the whole picture. Now, if Bitcoin is at 100,000, Bitcoin say, oh my God, what a bear market. Oh, how terrible. We're going to have to work at McDonald's again because Bitcoin is really taking a hit at $100,000. And that, of course, explains a bit why every correction we had, it's not going to zero, it's like going to cheap level, which would be like, oh, wow, it's at 90,000 now, what a steal. It's maybe at 80,000, it's even better price, but it won't go to zero. We've seen this cyclical adoption, which is very unusual. It's now we know it's not one bubble thing, like the Beanie Babies thing, and that was my original perception when the first big adoption. I knew, okay, we've seen it before, now that's the thing. Everyone will buy until it'll drop again, and then everyone will forget about it, and that'll be it. We've seen this very unusual adoption pattern of new higher lows than before, and I think that's best explained for the regression theorem of Bitcoin, of Mises. So rather than contradicting the story of Bitcoin, I think it helps explain it a little bit more, that there's this historical kind of adoption of it. So we've reached the level where Bitcoin enters as a conservative asset in a portfolio that even banks start recommending or allowing the people. In Switzerland, banks are even starting recommending it. That seems very odd. I would not have expected that to happen within my lifetime early on. And that tells you why you can't just ignore it and it won't go away. And I think the biggest mistake you can do is look at it as if it was something new, something that you've discovered now, and try to figure out. And then I think the reasonable initial reaction will always be, probably I'm too late with that shit. I missed it, okay, it worked out well. I'm going to stay away from it because I don't get it immediately. And I think once it has reached that proportion, you can't really miss it or ignore it, and it won't be to your benefit. So I'm still not recommending anyone to buy anything. I'm just describing what time we've reached in the adoption. Now in Switzerland, where I live, in particular in the canton, we already have public advertisements by traditional banks by Bitcoin. I wouldn't do it, but that has happened. Now, of course, any asset where the transaction partners can benefit from will be sold. There will be the infrastructure for that. The interesting thing is that it has not lost its attributes of portability and durability yet. I was always worried about it, that it may lose the fungibility. It's still possible to use Bitcoin as it was meant in a self-custodial way, in a peer-to-peer way, without asking anyone permission. And I think that was the huge actual portability, durability advantage. Now, I think the reason why diamonds appeared and Amsterdam, when it was part of the wealthiest part of the world, became a center for the diamond trade. Diamonds are clunky things. They are not really useful for day-to-day transactions. They don't make a lot of sense if you look at them from an intuitive way. But still, they had, for a certain context, a superior salability. And the context was, of course, you could sew diamonds into your garment. And you could pass borders by transporting huge amounts of wealth compared to even gold and silver. And I think that's the underrated aspect. That's just a few people, but it's the people that matter. That may be the people that start a new industry at another place that's more conducive to starting a new industry, when at the place you're coming from, it's not, it's masochistic, maybe even to start a new industry. And Bitcoin, of course, surpasses diamonds in that regard. You can transport almost unlimited, or I say like the billions and multi-billion order kind of wealth by just remembering 12 words, which everyone can manage in your brain wallet and pass any border without leaving any trace. And that, I think, is a superior form of withdrawability. For now, it's not a huge part of the Bitcoin adoption. The bigger part of it, and that also gave me a hard time, I told you initially I was very skeptical about libertarians adopting their magical internet money. Already I had a quite negative perception of US libertarians. I was like, okay, it's like a kind of LARPing. I didn't take them too seriously. With Bitcoin, interestingly, there's a story about it, and it unites people that are skeptical about mainstream structures, but it's something that seems to work out, finally. So you take a decision of withdrawing yourself, and of course the typical way you could withdraw yourself was always very defensive, like, oh, I'm not reading the newspaper anymore, I'll be on Twitter, kind of thing, and then I'll on Twitter or X now tell everyone how bad the politicians are until I'm canceled on Twitter, and then I move on to Telegram, kind of thing. With Bitcoin, it seems like you withdraw something from the system and you benefit greatly from it, and that of course changes the whole mood. That's why within the Bitcoin conferences I speak at, the mood is much more optimistic. It's like, yeah, maybe we'll win the thing. And that has been, so even though I thought ideology is really the worst thing you want to have when using money, it has turned out to be an important element that is part of a story. It's part of an anti-mainstream story. It's a part of a liberty story. It seems to work out. And I think that has made it easy to pass on about this retail adoption, which in total amounts, it's irrelevant, I think, compared to the BlackRocks and the rich guys moving money. But it's crucial because it installs a kind of lower limit of Bitcoin demand. You have this hodler appearing, which is great. It's just like holding. It means hoarding. The hoarder who's proud to be hoarding something. That's very unusual. And the hodler does it for a kind of perspective, positive perspective, that I don't know what the future will be like. Maybe it'll be better even. And I hold on to the wealth I can for that better future. And it has led to something else. I think I have realized that Bitcoiners tend to have children again, which is very unusual for Europe, where people are stopping having children. It seems the proportion of children coming to conferences and so on is going up a bit, like here in Bodrum has been the case, or there's something a bit more optimistic and uplifting there apparently, and I think it's this kind of ideological underpinning that I was a bit skeptical about that hampers also its use case and understanding as money, of course, but allows that there is a bottom line in the network effect of holding and using Bitcoin. And we have seen is like what has appeared out of that is first a good investment advice combined with an ideological story, which is dollar cost averaging, which you always buy, no matter the price, you always buy. And that has worked out pretty well as an investment advice because you are not doing the FOMO thing and the cyclical thing, and it's something you do constantly. So now we have a pretty large and growing minimum demand for Bitcoin of people just don't caring about the price. They have their savings plan working and just buying incrementally a Bitcoin. And I think in the long run, of course, that's something that has put it on the minds of the BlackRocks and have you this perspicuous pattern of it, which is quite unusual. So I hope to have made it a bit clear how Austrian economics doesn't directly recommend it, but makes it, I think, it's the best economics approach to understand it, and it shows the value and usability of praxeology, even for very complicated modern phenomena everyone has a hard time understanding. Thanks a lot for your patience.